So if you recently started a new LLC, new business, or a new side gig, and you are not taking the tax write-offs that I'm about to share with you, then you may be overpaying on taxes. Tax write-offs reduce the income you report on your tax return, which means if you miss them, you will report more income than you have to and therefore pay more taxes than you actually have to pay. So as a licensed CPA that tax plans every day at mycpacoach.com, I want to share the top tax write-offs for new businesses with you. So let's jump right in. Okay, so let's start from the very beginning by going over number one, any startup costs you incur to start your business. So even before your business officially starts, the tax code allows you to write off any startup costs that you incur to actually launch your business. This includes any cost that you incur to investigate the creation or acquisition of an active trade or business to help you make a decision on if you want to pursue that business or not. So if you incur costs related to the research of your trade or business, like buying courses to learn more about it, or hiring consultants, or even paying for things like market research to understand the business more, then all of that is tax deductible. It can even include travel expenses if the travel is related to the business concept, whether it be to get ideas of potential business locations or customers that you may want to target. Those costs as well can be tax deductible from a tax perspective. So think of any cost you incurred to formulate your business concept and ask your CPA if you can deduct them on your tax return. As of right now, the tax code allows you to write off up to $5,000 of startup costs in one given year, and any excess can be taken in future tax years up to about $50,000. And I see a lot of new business owners miss this deduction altogether, so make sure you notate this. Now, the second bucket of costs that you can write off as well is number two, any organizational costs you incur to launch your business. So like startup costs, organizational costs are also tax deductible expenses that you may have incurred before your business actually started operating. But these costs are directly related to the creation of your business entity, like legal and accounting fees, for example. So if you use a legal service to form your LLC or corporation, or if you hired a CPA like me to structure your entity from a tax perspective, all of that would be tax deductible here. This also includes any filing fees for your entity, your state registration fees, and any other legal fees that are directly related to your business. Up to $5,000 of these types of costs are also tax deductible in one given year, and up to $50,000 of these costs can be deducted in future tax years. And remember, this is a separate deduction from the startup tax deduction. So hypothetically, you could write off up to $10,000 of both startup and organizational expenses in one given year, depending on your qualifying expenses. Now let's move on to when your business actually starts earning income and talk about number three, the QBI deduction. So as your business operates and earns business income, it is extremely important that you do not miss the QBI tax deduction. Now, this is a freebie tax deduction that grants you a 20% write-off against your business income. For instance, someone with $100,000 in business income will be able to write off about $20,000 and only pay tax on the remaining $80,000, which would save someone in a 32% tax bracket about $6,400 in taxes alone. Now, while this is a straightforward tax deduction, it is not automatically applied when you file your tax return. And because of this, a lot of people miss this deduction when they actually qualify for it. So make sure you make note of this for when you file your business taxes. Now, you can take this deduction as an S corporation, as a partnership, as a sole proprietorship, or as an LLC that is being taxed as any one of those classifications. But you cannot take this if you are set up as a C corporation from a tax perspective. Plus, there are some income limitations as well. You automatically qualify for this if you earn less than $192,000 in annual income as a single taxpayer, or less than about $384,000 with a spouse. And if you earn above those threshold amounts, you may still qualify, but there are some more stringent requirements that relate to the type of trade or business you have. So be sure to talk to your CPA about this if that is you. With that said, let's make sure you don't miss another easy tax deduction with number 4, the home office deduction. So if you use any space in your personal residence exclusively to work on your business, then you may qualify for this tax deduction. And if you do, then it would allow you to write off a percentage of all of your home expenses as a business tax deduction. So for example, if you use 10% of your home exclusively for your business and you have about $80,000 in total home expenses, then you may be able to write off $8,000 on your business tax return to reduce your taxes. Now, to qualify, you basically would have to calculate what percentage of your home is being used exclusively for your business, which may include any office space in your home to work on your business or any storage space to store any business products or business equipment that you may have. And you will use that percentage against all of your home expenses to calculate your home office deduction. Now, another common one that a lot of new business owners miss is number 5, the vehicle expense deduction. So if you use your car for a valid business purpose, the tax law allows you to write off the business usage of that vehicle. For instance, if you use your car 50% of the time for your business, then you can generally write off 50% of your vehicle expenses under the actual expense method. So in that scenario, if you had $20,000 in vehicle expenses, you would have a $10,000 write-off. Now, alternatively, you can elect the standard mileage method, which will grant you a fixed tax deduction per business mile that you drive. For example, in 2025, this deduction grants a 70-cent deduction per business mile that you drive. So for every 1,000 business miles, you would be able to write off $700. Plus, there are also additional tax deductions that you can take when you are purchasing a new vehicle for your business, like number 6, depreciation. So whenever you buy any tangible asset for your business, whether it is a car, equipment, machinery, or any other type of tangible property, the tax law generally permits you to take depreciation. Now, this is just a non-cash expense that you can take on your tax return over the expected life of that asset. And to learn more about that, the IRS has tables that will classify your property according to its useful life, ranging from 3-year property all the way up to 39-year property. And you can generally take depreciation against your business property evenly over that period of time. For example, a $20,000 car with a 5-year useful life would have a $4,000 annual depreciation deduction over that period of time, or 5 years. Now, with that said, the tax law also gives us multiple ways to calculate depreciation, which in some cases could allow for up to 100% of the business property to be expensed in one given year. For example, Section 179 depreciation allows this for certain types of property. And there's also bonus depreciation and many other types of depreciation methods that taxpayers use to get larger deductions on their tax returns. But as a new business owner, what is most important is that you understand that you can expense a portion of assets you buy to conduct your trade or business with depreciation. And again, many tax professionals miss this altogether. So make sure you bring this up to your accountant if you buy any property related to your trade or business, and make sure that you're getting the largest deduction possible here. Now, usually when I'm dealing with new business owners, I also find it very beneficial to mention number 7, advertising costs. So this is actually a tactic that I have used to consistently offset my clients' taxes, sometimes completely, while growing their business, and is based on one simple concept. Spending money on advertising is 100% tax deductible. So when there are plans to grow the new business quickly and there are substantial profits being left in the business, then sometimes I would suggest that we reinvest those profits into more advertising. And the logic here is that this may allow you to grow your business quickly in terms of sales, while also offsetting those sales with advertising expenses that you incur that ends up saving you more money in taxes. And once the business grows to a certain level, then ideally you could pull back and reduce your advertising expenses and leverage other beneficial tax strategies. So if your plans are to grow your business, then this may be something that you can use to your benefit that would in turn promote your business while paying less taxes to the government at the same time. Now, in addition to what we've covered so far, it is also very important that you understand that you can typically write off any ordinary and necessary expense that you incur to operate your trade or business according to Section 162 of the Internal Revenue Code. This includes costs for employees, contractors, cost of goods sold, office expenses, rental expenses, and quite literally over 100 other types of expenses and deductions that you can take on your tax return. So when in doubt with a potential deduction, you can always refer back to this provision in the tax code and look into ways to write off that expense on your business tax return. But the deductions we cover today should be low-hanging fruit for most new business owners watching this, like writing off your startup and organization expenses, taking the QBI deduction, and writing off portions of your home expenses, car expenses, and other type of expenses should all be things that you have in your arsenal come tax time. And if you want to learn more about those, make sure you subscribe to our channel. And if you need immediate assistance to reduce your taxes, like right now, then just apply to work with one of my CPAs today at mycpacoach.com.